Welcome to Ownership, the podcast where we have conversations about capital formation in crypto and beyond. I'm your host, 8-Bit Penis. This is season 1, episode 7, and today I'm joined by no other than Proph3t himself. Welcome, Proph3t.
Thanks for having me on.
Yeah, this is a huge pleasure of mine to have him on. He is the founder, as most of you know, or the co-founder of MetaDAO, the fundraising platform that is revolutionizing fundraising today. And they have also pioneered futarchy on chain, at least on this scale, they definitely have. And let's jump right into it. So Proph3t, I think one of the questions that I've always had is, how did you come across futarchy? Like, what was that like? Where did you find it? Were you just reading? Did you just read the original white paper, or where did that come from?
Yeah, so I actually found decision markets through a YouTube video. I don't remember the specifics, but I think I was going through some Ethereum at the time. I was working with Ethereum DeFi, and I was watching some talks at Ethereum conferences, and then I came across one where they talked about decision markets, and I was like, oh my God, this is awesome.
And did it click instantly? Like, were you obsessed at that second, or was it something that just grew on you over time?
Uh, it did kind of click instantly. But it also it clicked instantly as in, wow, this is really interesting. And then over the span of a couple of months, I was like, oh my gosh, this is really cool.
Was it for you? Was it about like decentralized governance? Was that the part that really resonated with you, or was it, I guess, finance or markets making large scale decisions or important decisions? Like, were you always somebody who's been interested in decentralizing governance itself?
No, I never really cared about the decentralized part that much. It was more, um, so I'd been into markets ever since I was a kid. Like, I guess a lot of people are into fantasy league and whatnot. I was into the stock market. And uh, yeah, I mean, one thing you learn in markets over time is that it's generally hard to beat them because you have all these smart people around the world that are competing to predict the future. And yeah, it turns out it's hard to beat that. And then yeah, I'd seen uh, some examples of misaligned decision making, essentially principal agent problems. Like at a big company, I think empire building is pretty common. Like managers will assemble large teams just so they can get promoted, because it looks good if you have a large team under you, even though that's like expensive and time wasting for the company. And so yeah, it was those two things that I think made me really bullish on this idea.
And well, while we're at the topic of futarchy, I feel like if there's anybody who can explain futarchy, it's going to be you, because you've probably done it thousands of times. People probably come to you with this question a lot. And so I'm going to ask you that question again, which is, what is for you the easiest way to explain futarchy and why it can make good decisions? Does it make better decisions, in your opinion, than humans do? And why?
Yeah. So the way I generally explain decision markets, and yeah, I generally I don't use the word futarchy anymore, just because I think it sounds too much like alien space technology as opposed to a commercial thing. Although other people are obviously welcome to use that term. But yeah, so the way I generally explain decision markets is via an example. So um, imagine Apple is deciding whether to fire the CEO, who's Tim Cook. Today, that's a board of directors that makes that decision, right? Like they come together and they place a vote. Uh, in a decision market, instead, what happens is people trade in markets of what Apple stock would be if you fired Tim Cook and what it would be if you didn't. So yeah, we could have an Apple stock if we fire Tim Cook market, and if I place a trade, like say I buy one Apple stock for $100 in that market, then my trade is only finalized if he's actually fired. And otherwise I get my money back if I place to buy. And so essentially it allows me to bet on or like trade on what the impact of firing Tim Cook is. Like if I'm more bullish firing Tim Cook, or like if I'm more bullish Apple if they fire Tim Cook, then I'd probably be willing to buy Apple stock for a higher price in the if you fire Tim Cook market. And then yeah, you take both of the prices of both these markets. So like if Apple stock is worth $110 is in the if you fire Tim Cook market, and $100 if you don't in the if you don't market, then that's the market sending a signal, hey, Apple would be more valuable as a company if we got rid of this current CEO. And so you can use that as information to make the decision or to directly make the decision. That's what decision markets are. To your second question of are they good, I guess. I mean, so there are three reasons why markets might be better than like the typical ways we make decisions today. The third being, I think, the most important. So, number one is that markets can simply aggregate more information. So, like the election markets, for example, like who's going to win the U.S. election. You have people all around the country trading in those markets, and you potentially have insiders trading in those markets, like poll workers on the last day, and so there's lots of information that can be dispersed and is not just cannot be easily extracted by like a poll worker, right? Because that's the alternative predictor. And then the second benefit of markets is that they have the incentive to self-correct emotions, essentially, right? Like if you're a trader, and I would consider myself a trader, and if you see everyone is like down on sentiment on an asset, that's a time when you start looking at the asset to buy, right? Because that is one indication that it might be underpriced. And if everyone is like really exuberant about an asset right now, that may be an indication that you want to short, right? Because it could be in a bubble or like yeah, it could be at its like narrative high point right now. And then the third one, and I think this is the most important, is the principal agent problem, which is, yeah, like that a manager doesn't necessarily have the same incentives as the organization. I mean, empire building is a great example of that, right? Like it's in the manager's interest to have as large a team as possible, but it's in the company's interest to increase its profits as much as possible, which implies lower costs. And yeah, so I think that this is actually like a really big problem. Markets don't have that, right? Like when people are trading the price of Apple stock, they are only considering whether it makes Apple more valuable or whether like um, whether it increases or decreases what people think makes it more valuable. They're not thinking about like, oh, but I want like a bunch of people to work for me, so that's why I'm going to place this trade. There's no separate incentive. And yeah, so I think like obviously we've got to run the experiment for longer to have definitive data. I already think decision markets are better than the status quo for crypto organizations, which is where we operate today, simply because there's been so many problems with crypto organizations and like so many rugs, which is just another principal agent problem. But yeah, I mean, time will tell. I obviously believe that they will be better than at least a decent chunk of decision-making systems, but like we'll see.
I think you already mentioned that in crypto we can apply decision markets. Do you think decision markets can eat into traditional markets? Like, do you see in the future a world where instead, let's just say some board decisions are given up to futarchy. Do you think that is the ultimate goal? Like, what is the ultimate goal? I guess, or North Star in the grand scheme of things between MetaDAO and then futarchy. Like, how do we bring this to the larger to a larger crowd?
Yeah, I mean, the ultimate goal is quite radical. It's market governed civilization, or like more rational decision making, like civilization as a result of um, markets. And in terms of how we get there, I mean, there's a few ways. Like if you're trying to get there, there's a few ways you could try. One is to get these larger organizations, yeah, to do what you're talking about, like have some board decisions, go to decision markets, or maybe have some like lower level, maybe hiring decisions, like whether we should hire this person, be traded on in decision markets. Uh, and I don't think that that is going to work for a few reasons, or at least it would be much harder than the alternative, which is uh, having new organizations that are created with decision markets from the get-go as having some import and power within the organization. Um, and yeah, so the way that I think we get there is essentially through these smaller organizations getting bigger, as opposed to getting, I mean, maybe there will be some of the getting larger organizations to adopt decision markets, but I think the main path is by getting like net new organizations and then having them grow.
That's very interesting because not a lot of people would say that they want um, the whole civilization to be governed by futarchy. I think most people would say, well, yeah, it works for corporations and it could work for that, but it seems like you may believe that it could work for political decisions, I guess. Do you agree with that statement that it could work for like, I don't know, USA something, I don't know, go to war with somebody and we leave it up to a decision market or some crazy thing like that?
I mean, yeah, I think it works, or like I think it will work. Yeah.
Do you not do you not are you not afraid of, I guess, the common criticism of that is, well, how do you make a KPI that the markets can price? Which also kind of brings us to the question of why price is a KPI for MetaDAO specific implementation of decision markets. So for anybody who's listening, the original idea for futarchy and decision markets, it didn't specifically say that it had to be, the KPI had to be a price. It could have been any arbitrary KPI that people agreed on. And so, yeah, could you expand on that?
Yeah. So, yeah, okay. So it is hard to pick a KPI. Like for example, an example of this is, say you want constituent satisfaction or happiness to be your KPI for your government, right? Uh, One question is just like, how do you measure that, right? Do you have everyone do quizzes every year? In which case you're only really measuring their 1 year satisfaction, but like fine. And then they just grade it. But like how do you adjust for the fact that different people may just grade differently? Like maybe you and I share the same level of happiness, but like I'm at a 9, I would rate it a 9 and you would rate it like a 7. Um, do we somehow stick like some metering or monitoring equipment on all of us, or like measure us like physiologically, like stick some like dopamine measurement tool on all of us? Like that seems really impractical and hard. uh or is, yeah, and I can't really think of any other way off the top of my head. And so there's the measurement problem, and then there's also this problem of uh how, whether or not that is really the metric that we want, right? Like if you have this self-reported happiness score, even if it's accurate, or sorry, even if it is accurately reflective of our happiness, how do you deal with decisions that are really going to be good for our next year's happiness, but then really bad for like the year after that, right? Like, say there's a proposal to increase the debt by twofold and to use it spending money on like parties for all the constituents or something, right? Like that will probably make us short term happy, but not long term happy. And if decision markets are just trading on what the constituent satisfaction score is going to be next year, based on which option we take, it's probably going to take the short termist decision. Um, and yeah, so price of a capital asset like a token uh, or a stock is pretty nice because the stock is already the objective function of a company, right? Like if you establish your company in Delaware as a C corp, you've resigned yourself to the idea that the whole goal of the company is to increase shareholder value. It's not to solve world peace or anything like that. It's just to increase wealth. Um, and so that's why like and also yeah, the stock price is like reflective of wealth, right? Like um obviously markets are not perfectly efficient, but if a stock price is wrong, then you can make money. Because if it's too high, you can potentially make money by going directionally short, either through shorting or through holding puts. And if it is wrong, like if it's too low, then you can buy. And Yeah, so that's why price is pretty nice, and we for all of our decision markets use price. Like people trade in markets of what the token would be if you did something, and if you didn't, what the value of it would be. And I actually think that this objective function of value per asset, uh, where that asset represents the wealth of an organization, as like a token can and as a stock does. Uh, is actually maybe not the worst one for a society as a whole. Uh, the trick is that you have to find some like manipulation resistant quote asset. As in, if you just use US dollars, but then the decision markets themselves control the central bank, then obviously what they're going to do is just print a bunch of dollars, right? Because that'll make the ratio between dollars um, and the underlying asset go up without actually increasing wealth. And so if you have some sort of quote asset, then actually can measure wealth, uh, as in, and when I say wealth, I mean like essentially things that produce stuff that we need. Then really it's actually not a terrible metric, right? I think like at least if we're going towards at least if our goal is to have a post-scarcity society, then that uh metric would get us there. I know that's like really abstract, but yeah, basically I think it may work as an objective function for larger organizations and not just corporations. Or maybe what a larger corporations can just fulfill the role of what like a government has done historically.
Is there any decision, and I think you already hinted at this, but what are some decisions or some examples that you would not leave up to futarchy? What is something that you think shouldn't be left up to futarchy? And as you said with the central bank and the dollar, that's a very good example. But are there any shortfalls, I guess, that you think futarchy and decision markets are vulnerable to?
Yeah, so I think a big problem that I haven't been able to get a solve for, and maybe it seems likely that we'll never have a solve for, is decision markets can't deal with doom or like the risk or E risk or X risk, like the risk of a world blow up, right? Because um, any rational bettor is happy to always bet that the world is not going to blow up because if the world blows up, then the underlying asset is worthless anyway. Um, and so yeah, and so like with decision markets, you can imagine a scenario where it's like, what would our happiness be if we like nuked this other country and like you can't really you can't really price the risk that they then nuke the whole world because, or even just like maybe your society, because people are happy to take that trade of like, um, always betting on doom, and always taking the thing that's like risk on in that regard. So yeah.
Yeah. So I think the as MetaDAO started was a futarchy platform, or you guys started with basically a futarchy as service platform. Is that correct? Right?
Yeah, we
Um,
spent about a year on like
yeah.
I mean that is the obvious thing to build, right? If you're trying to build a new decision-making system, the obvious and you're in crypto, as me and Colin were, the obvious thing to build is a governance platform. So yeah, we spent like about a year focused on that.
Yeah, so you guys spent a year on working on futarchy. You got a bunch of DAOs trying it out, but what I am wondering is how did you guys arrive at the conclusion that yes, we do have to make something more, something that you know uses this futarchy that we've been working on for so long. How did you guys arrive at the conclusion that okay, we're going to make a launchpad? Is it something that you as an investor, as a trader, as a crypto participant experienced? Was this an opportunity that you thought was a good opportunity because there was a hole in the market? Or yeah.
Yeah. So we didn't really find PMF. I think uh that was a big motivation. And so we were looking at alternatives. And at the time, I think it was actually DAO's Fun that was like the final straw of like, yeah, so at the time DAO's Fun was kind of popping off. Like you had all these people who were raising money on DAO's Fun, like doing these mini ICOs. And we were like, oh my gosh, decision markets would be great for ICOs, right? Because we had seen firsthand that the number one problem with ICOs is rugs, right? Like if you look at Solana 2021, you had all these big ICOs uh, that didn't really work out, and most of them were arguably rugs. Um, and yeah, you had a system where instead of the money going to the team and it sits in this decision market treasury, that seemed like it would fix that problem. And so that was the motivation.
I feel like you're a little bit underselling of what MetaDAO pioneered, because MetaDAO pioneered something that has never really been done before. To me, it wasn't just the decision market; it was the fact that the treasury was, we could liquidate the treasury. You could do basically you could do buybacks, liquidations, and most importantly, or at least in my opinion, one of the most important things is that the intellectual property
Right.
and the legal side is also nailed down. So that was what I experienced, and when I first saw MetaDAO, or at least the new Launchpad, that's what really stuck out to me. Is like, yeah, you guys are making something, not just a governance platform, not just any type of Launchpad. It's not just that it's unruggable; it's that it's making tokens worth something and represent something that's valuable, and it accrues value just by itself. You don't need revenue share or all of these mental gymnastics that tokens had done before MetaDAO, and so that is something I'm also curious about. Like, where did the idea of of an ownership coin come from? Like this name has stuck with you guys,
Yeah.
and so I'm wondering where did that come from, and yeah.
Yeah, I mean, if you're gonna build a fundraising platform, you may as well build like the best one you can, right? I think that was a big part of the motivation because yeah, we had realized, okay, um, this problem solves this problem, as in decision markets can help mitigate this rug risk, which has been the number one problem. But then there's other problems with tokens that we ourselves had like kind of thought about. So yeah, one is this token equity split problem. Like Uniswap was the poster child of this, where they have Uniswap Labs that has made all this money, hasn't necessarily gone to the token. Now I think they're talking about unifying it, but Uniswap has been around for like 8 years at this point. So that's yeah, probably a little late. Um, and and then yeah, I think the other point that I like to talk about, and yeah, so we have this legal structure where the intellectual property is also controlled by decision markets, which kind of uh, can mitigate some of these risks, and can also mitigate the risk of like people rugging the token, right? We've seen this a few times where like a project is actually successful, they have a token, but then they just don't do anything with the token and it bleeds to zero. A few projects on Believe are like this, and then there are also a bunch of crypto native projects like this. And then yeah, the last point that I think we really like is this idea of teams only getting paid when participants are getting paid, right? Like the performance package where teams only make money when it's like 18 months post ICO at least, and and at least 2x the ICO price, like it's maintaining that over a period of 3 months. Um, and which is also kind of like radical in the context of crypto, where teams can make lots and lots of money even if the token is down 95%. Uh, and yeah, so yeah, I guess I'm not sure if that answers your question, but that's kind of how we thought about it.
Yeah, I mean that is absolutely fascinating, and I think a lot of crypto participants are, they're so used to these old token structures that when they look at something like MetaDAO, they get a little bit scared with the raise mechanism, and they usually bring up criticisms like, is this structure where the token holders can essentially liquidate a company on demand? Which, I mean, this is just what they say. I know it's not necessarily true, as they have to go through a proposal, but how do you respond to that? Is liquidating an early stage startup 3 months into its development, is that something that is a feature, or is it a bug?
Yeah, um, I think this is a great question. It's one that I would have myself if I was observing the system, because there's definitely a desire or like an inclination to just take the equity and put it on the blockchain, right? Like replicate what exactly what equities do, and then have that in like token form, uh, and have that be what tokens are. And I think that that is essentially not going to work, because and I'll explain why. So this problem of tokens, or maybe we could just generally like crypto is kind of just another word for people interacting with finance over the internet, or like internet native finance that's not located in any one like geography's financial system. And uh and this problem of in this system people raising money over the internet, it has lots of adverse selection. And yeah, it's essentially like a lemon market, they're called, where uh it's where yeah, I mean, I don't really want to go into exactly what a lemon market is, just because it's something you can easily look up. But essentially, I'll give an example, which is the used car market, right? Like used cars are a lemon market because people like you don't really know whether something is a good used car or a lemon, it's called, which is like one that's going to break down in a few months, or is like really low quality, but they can just conceal that while you're test driving. And and yeah, so you can look at like how and you see this in crypto where not many serious founders come on chain to raise, and yeah, there's not like a clear way of identifying who's good and who's not. And so if you look at how lemon markets deal with this problem, like a big solution is refunds. Is like, hey, if I buy this used car from your dealership and it has this problem within, say, 90 days or something, I can come and get my money back. Uh, and yeah, so I don't know if our current mechanism is going to be the end game. In fact, I'm it's probably not going to be. Like I think yes, we might need more constraints on when these things can happen. Uh but I just don't think this world, like I don't think you can raise money over the internet and just after that point have complete discretion over the capital. Uh this maybe works in like very limited environments uh where the person is super legible, that like the founder or the person raising money is super legible, um and we can know somehow that they are not going to rug, but it's unclear what that mechanism even would be, right? Because you can't just use the fact that this person has been invested in by top investors um as proof that there's not going to rug, right? Like plenty of projects in crypto have raised from top investors and then rugged, right? Like Frentech, for example. And so yeah, that's why I think you need this sort of mechanism. Like you essentially need someone who's like you need the supply side of this market, which is the entrepreneurs to provide this signal, hey, like we're a good quality. Um, and that signal is like you if things aren't working out or if we're trying to like rug, uh, which is a broad term that encompasses both hard rugs and slow rugs, then you can get your pro rata share of the money back.
I think one very interesting point you touched on was that there's a big adverse selection in crypto,
Yeah.
and that is a huge problem of there's not enough good founders and there's not enough high quality founders here. So how do you think we can get those people to launch on like a startup in crypto or a MetaDAO? How do we get them on chain? What is the solution there?
I mean, that's the $1 million question. I think about this all the time because obviously that's like the main that would be hugely unlock our growth, which is what I want. I want MetaDAO to grow. Um, I mean, I I think there's a few answers to this question, and one is this token alignment thing, right? Uh, there are very clear cases of businesses that succeeded because, and not just because, but in large part because they had a token or they had this distributed ownership or belief of ownership. Hyperliquid is a great recent example where after they launched their token and they had all these people owning hype, and owning what they perceived to be a piece of the network, uh, the perp volume on Hyperliquid 6x'd. And then there's other great examples of that. I mean, I think Ethereum is a project that's benefited a lot from all the people that hold ETH. Mega ETH, their like mindshare, as measured by Kaido, went up 20x after they did their Echo round. Um, we have a bunch. I think MetaDAO itself, like we had an early stage token, which is pretty unconventional in crypto, and I think it's increased our probability of success that we have people who are like aligned with MetaDAO and want MetaDAO to win uh, financially. And so I think that is a huge unlock. There is this problem of like, it's not like we have, uh, it's not always easy to replicate that, like, because you actually need people to buy the token or buy the alignment units and then to actually contribute. By like in Avicii's case, Avicii's a great example. So Avicii raised on MetaDAO $3 million, and then immediately after they raised, or like over the period of the next few months, they 10x their users, largely because you had all these people on crypto Twitter who owned Avicii, or just who owned crypto, who owned Avicii, and like told their friends about it, or published tweets about it, or started using the product themselves. And that's an unlock that you don't have with like traditional venture financing. Um, and I think the other thing that we can potentially that I've been leaning more towards is that quality is very subjective. And generally what people mean when they say quality is legibility. Like, are they an easy to easy to ascribe value founder? Like an example of a highly legible founder would be dropout from Stanford who previously built a company and exited it. Uh, and yeah, that would be like a great example. Um, Versus there are lots of people who don't necessarily have those credentials, but actually could build great companies. I mean, a lot of the companies, the great things in crypto that have been built, like Binance, Tether. I mean, Pump Fund is a massive business. It wasn't like, at least if I were looking at each of their initial rounds, like it wouldn't be very obvious to me that they would succeed. Uh, and so maybe actually what we need to focus on is just serving those founders who are not easily legible. And because we have our strong token holder protections, we can fund those people, right? When we otherwise wouldn't have. Um, and this actually does have some historical precedent in venture capital, which is Sequoia, which I guess is like the most prestigious venture firm, ironically, because how Sequoia started was essentially like operating like an activist investor. Don Valentine, for example, invested in Atari. No one else wanted to invest in Atari because the founder is what many would consider like not a serious person. Uh, he had like a jacuzzi in his office, and as just one example, and no venture investor really wanted to touch Atari for that reason. But Don was like, "Hey, this is actually a pretty interesting business. Yes, the founder is rough around the edges, but maybe we can work around that." And so he invented this structure that was essentially just like stronger protections for him, where it was like he invested some money, and then it's called and then more money unlocked for Atari as they completed some milestones. He was also involved in the company and like trying to uh, correct some poor decisions. Um, and then yeah, Atari was obviously successful and they made money off that. So like I think that's a precedent of someone establishing stronger protections and then using that to fund businesses that otherwise wouldn't have been fundable. And like it's possible that our protections will enable the same.
So you guys had a token early on, as you mentioned,
Yeah.
and it can be considered controversial by some. However, it did, I think, work out for you guys quite a lot. And one of the reasons that it has worked out so well, at least in my opinion, is that the supply is actually mintable and it's not a fixed supply. So I think a lot of people who come into crypto and get familiar with it, everybody thinks that a fixed token supply is good because the supply of Bitcoin is, fixed, and therefore every other crypto coin's supply must be fixed. And this obviously doesn't apply, shouldn't apply to app tokens or tokens that represent companies. And you guys have raised through minting token supply quite a few times and have had proposals that both got approved and rejected. So my question to you is, for all the founders who are looking to raise on either futarchy, the permissionless platform, or MetaDAO, what are some learnings that you have, that these proposals have taught you about raising through futarchy with VCs or over-the-counter deals, discounts? How do we raise it, and how should founders approach fundraising after the initial ICO?
Yeah, I mean, this is a question I get occasionally. It's actually a pretty simple answer. And yeah, it's not when you need to raise money, you generally have all these larger venture firms that have not participated in your token yet because they can only really do size and they don't want to take the price impact or the slippage of entering a position. And then you have your project, which obviously wants money and can issue tokens. And so, yeah, the way that we've done it historically is you just raise a proposal to issue tokens. It can be in the proposal you stipulate who those are going to, or like the terms of that transaction, or it can be that you give yourself or someone discretion to like sell them on the project's behalf. Uh, but maybe at some terms, like maybe it has to be at a specific TWAP, time weighted average price. So yeah, it's pretty simple, I think.
How do you approach a proposal like that? I'm really just trying from the perspective of a founder looking to raise, like how do I go into raising more money through this mechanism? Should I be looking at, giving investors discounted deals, or would it be always at market price? Could you give us a little bit more detail about how you go about that?
Yeah, I mean, obviously it'd be ideal to not do discounted deals. No discounted deal has passed through decision markets thus far. Um, it also send like the problem with discounts, it obviously depends on the discount, it depends on the firm, but like sometimes people just use discounts as a way to make money without even being directionally long, right? If you get a discount and then you can maybe hedge on perps, uh, so yeah, make money via that without actually holding the token, like or holding exposure to the token. When really what you want is investors who actually believe in you. Um, and yeah, so that's I would say likely prefer to do as close to spot or at a premium to spot, which we've done before, as possible. And I mean, I guess going into the proposal, what I'm thinking about is just, yeah, how much do we need to get to the next level? And like where is that split going to be? And yeah, like for us, for example, a big portion of our spend is on legal and audit, right? Like making sure the smart contracts are secure, and making sure our legal infrastructure is robust. Because yeah, a large part of our product is this legal IP thing. So yeah.
And do you think teams should be? I know this is kind of not really related to this, but still, I guess somewhat with the recent P2P situation and the whole insider trading. Do you think teams should be trading their own proposals? Because we say, or at least the argument goes, that insider trading makes markets more efficient to some extent, and on some extent it may make them more unfair, which might discourage participants from, well, participating. So how do you guys look at teams trading decision markets?
Yeah. I don't have a clear answer here. I mean, and I'm kind of suspicious of anyone who does think that they have a super clear answer unless they've really dug deep, because economists have debated insider trading for like decades, right? There's always this tension between, okay, in a market, you want people who have edge or information or alpha to add that information to the market by trading against the market. But then also, if a market is filled with too many of these people with edge, then the market ceases to exist, right? Like there used to be prediction markets on Survivor, like the challenge show, uh, and who would be booted off. And then the TV crew of Survivor found out about these markets, and then there were no more prediction markets on Survivor because they just um, traded against them. And if you're a normal person, there's no like that you're just trading against someone who has way more information than you. There's not really fun in doing that. Um, so yeah, obviously, uh, most countries, I believe, do ban insider trading on like stocks. Uh, so it seems like that consensus, or like the governmental consensus has been, yeah, it's bad, so don't do it. But then obviously you have lots of economists who are still arguing that that insider trading can be good. I mean, yeah, this Polymarket situation, like listen to the 60 Minutes interview with Shane, the CEO of Polymarket, and when they ask him about insider trading and what he says, he's not like, oh, insider trading bad. He's like, if you want to trade in these markets, you want to have an edge, right? Um, and the people with edge surface the good signal. And so yeah, there's always been kind of this tension here.
Yeah, I think I fully agree with that. I think it's definitely something extremely hard, especially when it comes to crypto, and it's very hard to even track insider trading because most of the
Right.
most crypto is pseudon, well, anonymous kind of. So it's very hard to track that, which kind of begs the question of, is it even worth tracking it? But I think, okay, so do you think that currently MetaDAO is too founder unfriendly? Because that's definitely, some criticism that I also see. And how do we make it more, how do we cater more to founders? How do you guys cater more to founders when it comes to raising a MetaDAO? Is it no liquidations for a couple months, or just having team only proposals? I know you guys are doing optimistic governance, which I think is a huge improvement in that regard. But what other systems can you put in place that could help with that?
Yeah. Yes, I think that we need to be better on the founder side. I think we're already a 10x better product on the participant side, and now it's just about those people discovering that we're a really good product, and we need to make it better, probably by an order of 2x on the founder side. I think what that comes down to is uh, essentially reducing entropy, or like reducing chaos. Proposals themselves are like kind of a pain, right? Uh, Aside from the time that it takes to write the proposal itself, it's just the drama of it that I think doesn't resonate with a lot of people, including myself. Like proposals just don't feel professional, right? You have uh, people fighting publicly about your project, uh, and yeah, saying things that you don't really want to be like spread as like go through the Jupe governance forums, for example. Like not really a happy place. And yeah, so I think we're kind of all about governance minimization. Like you just want to, our goal is to protect participants. It's not to instill community governance. And we need a product that truly reflects that. Like one idea is, yeah, what you mentioned, where you only let these liquidations or these buybacks happen in specific periods, like every 3 months or so. P2P actually, when they raised, we said, or we put in the terms that you there's no community proposals for 3 months, only at MetaDAO's discretion, but only community or only team proposals for 3 months. Uh, and I think I mean, maybe we actually don't need these buybacks to happen via proposals at all. Maybe we just, um, like one idea is we just get rid of community proposals, or we make them like very hard, and we just have the team can raise proposals, and we have some rug committee, which is maybe just like the MetaDAO team today, or maybe some like broader cohort of people that can all raise proposals if there's been like an outright rug, and the buybacks just happen automatically. Like if you're trading below NAV, then buybacks start, and it happens at a fixed rate, so founders can kind of know can better plan their financing, as opposed to just like not knowing whether they're going to wake up to a proposal that tries to take away some of their money. So yeah, I think those are kind of like how I'm thinking about it right now. Yeah.
Yeah, I think that's. I was actually surprised with because I know that you guys put this in place of no no community proposals for 3 months, as you mentioned, for P2P. So I was a little bit surprised that they are doing buybacks. Do you think
I
that
was
these
surprised
buybacks?
too. Yeah.
Yeah. Do you think that these buybacks are good for these companies? Do you just have a neutral opinion, or what fault does it surface? Like why do these happen? Is it flippers trying to exit from the market, or the ICO immediately? Is this something that's on the ICO side? Like why do these keep happening?
Yeah. I think buybacks are like a very nuanced topic that most people who have public opinions on haven't done enough basic math or just like thought about the system enough to have a public opinion on. That's kind of one of the things about economics is that things are actually pretty complicated, but everyone feels like they can have an opinion. Um, and so like one thing is I basically don't think that you can have an opinion on buybacks irrespective of the price of those buybacks, right? Like imagine you're a company and you can buy back 90% of your shares for like $1, right? You're obviously that's going to be super accretive to the remaining 10%. They're they now own per person like 10 times more wealth than they did before. So, like, obviously, they can be useful to accrete value. Um, and then, but if you buy back at like really high prices, this is what I think a lot of the ire for buybacks within crypto comes from, is like there's a lot of projects that just buy back their tokens in bull markets and then don't do that in bear markets because their goal is just like, oh, when I buy back and the price goes up, that's a good signal. When I buy back and the price doesn't go up, that's not a good signal. And it's like, no, you're a trader, like you're operating in a market and and you're buying and selling, and it's good to buy low. It's not good to buy high. And I think a lot of it comes from like not really thinking from first principles. Also, there's just like this emotional element of in a bear market, I want to conserve cash because it feels less exuberant. Um, so yeah, there's that. But then, I mean, I think that is maybe we could all just call that like potentially just financial engineering and like maybe not long term important. For us, buybacks are really important because they are this like anti-rug mechanism, right? If you have a slow rug, it's not immediately clear whether it's a rug or not, and so you need some method of determining whether it's a rug, and then the question is just like, what do you do if it's unclear? And you probably don't want to just take away all the money. And so yeah, our method is like we have this market that essentially is deciding like if dollars are trading for 50 cents, that's the market sending a signal, hey, the marginal dollar is best not allocated here. We should take back some of the money. And so yeah, that's kind of like my full opinion on buybacks.
Cool. And we are starting to come to the end of the episode, which means I think I would have, I guess, one more
Yeah.
question before we close it out and wrap it up, which is, you used to be, as far as I know, you come from Ethereum land, or you were an Ethereum developer, from right?
Yep.
Yeah, and so that does bring out the question of why did you guys end up choosing Solana? What was, especially when MetaDAO started, Solana was nowhere near in the shape that it is today. And ever since then, obviously, things have turned out to be quite good. And it seems to me that it was the right choice. But why did you guys choose Solana? And yeah, why?
Yeah, that was probably a top 5 decision along with rebranding to ownership coins. And the motivations were basically two. A, I was bullish on Solana, and both the asset and the chain itself. And B, uh, at the time, all of the important DAOs were on Ethereum mainnet. And you really just cannot run decision markets, or you couldn't run decision markets on Ethereum mainnet, right? Like at that point, even Snapshot didn't put its voting on chain because it was too expensive. Now we have decision markets that do, say, like 20 or 40 trades per participant on average. Like if you can't do one, you can't do 40. And so yeah, Solana I think was like uh the second best ecosystem, but like at the time, or like second biggest ecosystem, but then actually you could run the thing. So yeah, that those are like those are the motivations.
Yeah, man. I think that means we can wrap up the episode. Thank you for coming on, and thank you for the audience for tuning in. And also thank you to MetaDAO for sponsoring the podcast. And I guess if you have anything else to say to close out, you can go ahead and say whatever you want.
I guess the final thing I would say is just like recently I've been meeting a lot with liquid funds to explain our model better to them. And there's like a few common misconceptions I find, and that's why it's good to have these meetings so I can dispel them. And one is, yeah, that we are like governance maxis or like anti-team or something. We are not. I mean, I myself am a founder, right? Like I want founders to win. We are just purely trying to solve this problem of rugs, which are a massive problem in crypto. And if you're working crypto today, like you are affected by them. Either you've been rugged, or if you work at a project, it's maybe getting discounted, like its token is getting discounted because investors think that it's like that there's some probability that are rugs, right? Like Pump Fund is an example of this, where it trades at probably a discount because people know that the buybacks can turn off at any point. And yeah, so like that is our goal. It's not community governance. And if you have any ideas of how we can solve that problem in a governance minimized way, like we're all ears to that.
Appreciate that once again, and thank you for everybody for tuning in.
Yeah,
Goodbye.
thanks for tuning in. Thanks for having me on. Cheers.